Hey everybody, Signa here with the Bullish Bears. So I want to welcome you to the first video, probably in a series of three, where I'm going to talk about trading the Nasdaq using these new micro products, the micro Nasdaq, but we're also going to be looking at the micro ES, the micro Russell, and the micro Dow. Now the reason that we're going to focus on these micros is there's a lot of new people coming into the room that are coming into the idea that they want to trade futures, but they want to start small, maybe limit their risk. And these micros are kind of the doorway, the way to really get your foot in to the futures market. All right, so we we want to focus on these micros. Now that doesn't mean that you have to trade them. You can use the same tactic and the same theories that I'm going to be presenting here. You can use them in the minis. You absolutely could, but the focus is going to be on the micros for a reason. And there is a distinction between the two. The strategies that we use to get risk out of the market is going to be completely different. And the reason for that is because of how much we're willing to risk per trade. But before I get into the strategy behind trading the Nasdaq, I really want to kind of talk about why I would focus on the Nasdaq over the S&P. Now, most places focus on the S&P because with a micro product, you can make $5 for every $1 move in the ES. If you haven't watched my futures video, the introduction to futures, that would probably help you out, and you would want to watch that before you watch this. That way, if I am talking about things you don't quite understand, you'll be able to understand them better if you go and watch that video. So for every 1 point of the ES, you can make $5 with a micro. And for every 1 point move in the NASDAQ, you can make $2 in a micro. So more and more people think trading the ES is the way to go over the NASDAQ. And depending on the strategy that you want to use, that can be effective. But I trade looking for price to move, right? And in that movement, it's where I make my money. So the NASDAQ moves more than the ES typically. And so percentage wise, at the end of the day, they're relatively equal. And that's not always true. They're not always going to be 100% perfect, but money wise, they equal the same in percentage. So for an example, right now I have the NASDAQ showing. If we flip over to the ES and recognize the NASDAQ moved 1.45% on Friday. We're going to go to the ES. It moved 1.34 on Friday. So it didn't move as much, but it moved almost as much on a percentage basis as the NASDAQ, right? So what I'm telling you is money-wise, although the NASDAQ moves more, it makes less per point. And the ES moves less, but it makes more per point. At the end of the day, it's going to equal out in your account about the same way if you're trading one versus the other. But in the strategy that I use to trade, the NASDAQ is more appropriate for me, right? Because I look for a setup and then I trade that setup. I want to see the candles actually follow through with the pattern that I'm trading. Here on the NASDAQ, I've got a bunch of lines all over the chart, and it can look a bit overwhelming at first, but don't let this clutter turn you away from what we're wanting to do here. I want to just kind of start to zoom in a little bit. And what I'm trying to demonstrate is where price tends to become temporarily exhausted, where it pauses, where it runs into resistance. And recognize that these are quarter levels. 79.50, 79.75, 79.25, 7,500. These are roundies, halves, and quarters. And I named them that way when I was drawing the lines. Halves, roundies, quarters. All right? This is not an indicator. This is me just using the drawing tool. When I look at the NASDAQ, I look at it like an indicator. If you have ever used the RSI or the stochastics or the MACD, then you understand the idea of looking at an indicator and trying to determine trend and momentum from that indicator. Well, that's how I'm looking at the Nasdaq. Where's our trend? Is there momentum behind the trend? Right? And I'm using the actual candles and these lines just like you would use an RSI or a stochastics. Are we reaching an extreme? Are we anywhere near a quarter, a half, a roundy? And if we are, is there any conviction in the candles? Are we coming into that same level near a previous rejection? Are we coming back into it again? Right? All of those things help me determine if I want to pull the trigger and get into a trade. So when I'm looking to trade the Nasdaq with a micro product, I know that I can give price plenty of room because I'm not going to be taking a lot of heat. I don't want to trade large amounts of contracts, right? Maybe 3 or 4 at the most. That risks, that takes $200 of my account to be able to trade these, and you can grow an account, right? So let's just kind of back up for a moment. To begin trading the futures, if you don't have an account, there's 2 brokers that we point new traders towards. And the reason I say new traders is um, a lot of people don't have money, a lot of money to start trading, right? Um, they get a couple of $100 and they jump into the market. That is all you need to be able to trade futures, right? So with NinjaTrader, you need $400 account minimum to start trading. And with Tradeovate, you need $250 to begin trading. Now, I'm not suggesting that you only start with the bare minimum. If you have more money that you could put into the account, start with more, right? Give yourself that edge. But if you only have the account minimum, then that is going to be more than enough. The idea behind this is that you want to trade one strategy. You don't want to be a master of all. You want to be a master of one strategy, and hammer down on that one until you are consistently profitable. And you'll know you're consistently profitable because your account will grow. If you start with $4 or $5 or $600 and you grow that account large enough to begin taking contracts in the minis, then you're going to start bringing money in that is life changing, right? When we're trading the micros, our day done might be 20% of our account or 10% of our account, right? So say you make $40 with a $400 account. Hey, you're done for the day. Shut it down, right? And the next day, maybe you're only looking to make $4,400 on your account. And then shut it down. And each day, just keep aiming for that 10%. And you will grow your account if you're consistently profitable. And that's the idea, all right? As you grow as a trader and you continue to stay profitable, your account is going to get big enough to where you start trading these other products, the bigger ones. So the logic behind this trade is we're not scalping. Okay. If you look up the definition for scalping at Investopedia, it suggests that you're going to use an overly large trade contract size to look for a very small move in the market. That is not what we want to do with the Nasdaq. The Nasdaq moves a lot. It can get really whippy when there is news events coming out, or it's the beginning of the day, or at the end of the day. All right. We want to give ourselves plenty of room. We're not looking to hug price with a stop. We're not looking to just take small bites out of the apple. We want to determine a market direction, get into the trade, and stay for the duration of that move. And if you've noticed, I haven't moved the chart while I've been talking. I want this to sink in. I want you to see this, to visually understand that when we're talking about these quarters and halves and roundies, price absolutely respects these areas. Look at how many times we hit this roundie and was rejected. And when we broke through it, it was a solid breakthrough. That breakthrough came with conviction behind it. faded back down, and what was our resistance became our support. Okay? These levels are critical. You can anticipate price action reacting to these lines, and that gives us our trades. All right? We're not looking for 4 points. We're looking for 25 points, for 50 points, 100 points. And that is not an unreasonable expectation. Friday's trade right here, I'm going to zoom in. We went from 76.25 to 77.75. Okay, that's a 150-point move in the market in one day. That's not uncommon. Now, it was a Fed day. There was economic news that caused this reaction in the marketplace. The job numbers came out first thing in the morning, gave us that initial boost, carried us through the day. We had some good news in the afternoon, and we rallied into the close. All right? So we're not asking for an unreasonable expectation of price movement. Here's another day, September 11. The market rallied through the day. We went into the close, and that continued when the market opened back up. This is the Asian market opening at 1900 hours, right? So that's 7 o'clock. That's when Tokyo opens, and at 8 o'clock Hong Kong opens, right? So we're not suggesting that these are rare occurrences. This is an everyday thing in the Nasdaq. Here's another one where we went from 75.5 all the way up to 77.25. All right, we can trade these after hours. When the market stops, it is only closed long enough for the futures to settle, and then the market opens back up again. Now, you need a large account if you want to hold it into the close and back into the open. But you can close your position at the end of the day, let the market close to be settled, and when the market opens back up, you can get right back in again. It does not require an extra amount of capital to do that. Oftentimes, I will put a trade on and then go to bed, and I will lock in my profits to where there is no risk of me losing money. It's another trade that we'll talk about later on when we start getting into the strategy side and in the actual setups for the trade in the Nasdaq. And I got to tell you, this first video is really just going to be talking about the Nasdaq. I'm not going to actually present the trade setup in this video, because what I first need to get you to understand is that the Nasdaq is our indicator. If you want to trade the ES, you will still want to watch this video. And the reason for that is very clear. They move in sync more often than not. So if you analyze the Nasdaq and you determine that we're headed to the upside in a strong trend, you could just as easily use that for your basis of taking the trade in the ES, understanding that, well, the Nasdaq just bounced off the roundie, we're headed to the upside, and our overhead resistance is 50 points away, and we're headed there with conviction. I'll go trade the ES, knowing what? That we've got a long ways to go before the Nasdaq starts to run into resistance. If they move, comparatively speaking, equally, and I'm looking for a 25% move in the Nasdaq, I could comparatively look for a 25% move in the ES, and that's 0.25%, right? That's not 25%. Make that clear. So even if you're not exactly interested in trading the Nasdaq and you would rather trade the ES, you're still going to want to understand how you can use the Nasdaq effectively. And that's what this video is going to be discussing. When we're looking at the Nasdaq, let's just kind of jump into a 5-minute chart. So here we are on the day, right? This is Friday's price action right here. Where did the bell open? Well, that big candle right there is pretty close, because we know the job numbers came out before the bell, right? So we had the job numbers, which pushed us right through that overhead resistance. and took us right into the roundy. The bell rang, we broke the roundy, and we took a run for it. Now recognize what happened here. When we broke the roundy, we ran all the way up. We didn't just break the roundy. We ran all the way up to the quarter and then faded back down to the roundy, and it gave us some support. Sure, we crossed through it. We did. These are 5-minute candles. We did break through it. But the support held. We never came down to the quarter. When we broke back through to the upside, hey, there's your trade entry right there. Where are we going? When we broke through to the upside, we knew exactly where we were going. We were going back to this quarter. When we broke through the quarter on the next trip, where were we going on the next candle? When it broke through with conviction, we were going to the next quarter, which happened to be the half. Now, this does not always work out this way, right? Because there's no 100% of anything in the marketplace. The only 100% guaranteed thing that comes out of the marketplace is sooner or later, you're going to get your ass kicked. That's a promise the market makes everybody, and it does come through with conviction, right? But what we can say is that when we broke through here with conviction, we had a very strong determination that this was going to make it up to the quarter. When we broke the quarter with conviction, there was a very strong determination that we were headed to the half, right? And that's how we can use this in our trading. So why does this apply to the micros? Well, with the micros, we can give ourselves plenty of room to be wrong, right? And it still won't hurt. So suppose I was looking at this and I seen everything in the market Friday morning saying we're bullish, and yet the market is fading from the quarter. I could put an order in here at the roundy to go long. And I could put a disaster stop in place down here at the quarter to protect myself. The market comes down, I get into the trade, I start taking heat, I'm taking loss. But how much am I really risking? With one contract, how much am I really risking here? I'm risking 25 points, that's $50 with one contract that I'm risking. And where's my target? 25 points. So this is a 1-to-1 risk-reward ratio. I'm risking 50 to make 50. Is that fair? Yes, because I have a greater than 50% probability of being right. Okay? If I only had a 50-50 chance of being right, then that wouldn't be good enough. We'd have to risk more or risk less with a greater target for that to be appropriate. But 1-to-1, I'll take that in the Nasdaq any day of the week. Now, once we were in and it broke strongly, that big candle right there let me know, hey, game on, this is working out. We got a bit whippy here, came up and tested that quarter. When it broke the quarter with conviction, instead of closing my trade, I could have added another contract. Remember, by this point, I'm already up $50. I can add to my position when that candle broke through with conviction. Where would I have gotten in? Say anywhere in here, anywhere in the 30s. And we could have got in during this candle. I'm not suggesting that we couldn't. But let's be fair. Let's say that, we didn't get in during that candle. We get in during this one. So we get in the 30s. I'm already up more than 50 at this point, right? I'm up 60. But now I'm in it with two contracts. And from, we'll call it 35 to 50, that's 15 points with two contracts. That's $60, right? 15 points for one contract would be 30, but I had two. That's $60 on top of the 60 that I had already had. So now I'm up 120 and we're at the 50. We're at the 50 for the day, and I've made $120 with two contracts. You see how we're trading throughout the day. We didn't cut the trade short. We didn't bail out of our position. We traded throughout the day. And we still had no reason to close all the way up here at 1430, right? Because the trade continued on. Could we have taken profits? Absolutely. And I would never disagree with anybody who wanted to take some profits. You have two contracts on at this point. You could pull one contract off, take profits out of the trade. and you would still be long one. Where was your target? Well, from the 50, we seek the 75. That would have been our target. Now we're getting towards the end of the day, and we faded off of that high. So if you had it right at the 75, you wouldn't have got filled. All right. But by this point in the day, you should be looking towards your exit because it's a Friday. We know the market's going to close. We know we don't want to hold it into the weekend. We should be looking to close anywhere near that 75, right? And we're day done. Now, I trade a trend market. I don't like to trade a range-bound market, and this did turn into from a trend to a range, back to trend to a range, right? So we were already in the trade when it was trending, and we could have bailed out at any point with profits. But I just wanted to walk you through these steps. If you're looking to trade a scalp, or if you're looking to trade from point to point, there's nothing wrong with that. You can absolutely do that. But look at the price action on Thursday. So here's Thursday. We'll back the market up a little bit. So here's Wednesday at the close. The market opened back up. Here's the Globex hours on Thursday. Range bound. The market opened on Thursday. Let's turn on some lines and make this a little clearer to see. We'll highlight the extended hours. There we go. So there's Thursday's Globex. Range bound all night long. Didn't get anywhere. The market opened on Thursday and it got wild. It went whippy, right? But off of this low, we had an opportunity to trade. See where I'm trying to bring this into some perspective. Now, like I said, I'm not going to really discuss pulling the trigger and how to perform the actual trades. But the setup that I'm looking for, you're looking at it. I want to see price come down to a roundy, to a half, to a quarter, and I want to trade off of that roundy. When it's in the middle, I don't trade. I can just sit out and wait. There's nothing wrong with that. You can look at the market and you can say, look, you know what? It's range bound. It's in the middle of these two quarters. I don't have a trade. I'm going to put an alert on that line and I'm going to go do something else. Read a book or study, right? Spend time with the family. The alert goes off. It lets you know, hey, price just crossed one of those quarters. You come back in and take a look. Oh, we just tagged the 75 down here. And we're rallying off of a low. If I was to put on the fractal energy, I would recognize this V pattern formed right here. And I could trade this back up with each quarter being a target zone. Doesn't mean I would reach it, but that would be my targets. All right? This is how you can trade these. You wouldn't want to do this with the minis, right? You wouldn't want 25 points in the minis. That's a lot of money. That's a lot of risk. If we bring up $20 per point times 25 points, that's $500 of risk. I'm not comfortable with $2,500 of risk, but I'm comfortable with $50 of risk, right? Because we got a small account. You could start with a $500 account. You definitely wouldn't want to be playing around with that kind of risk, right? But $50, yes. And is it appropriate? Is it okay to take a trade based on these quarters? Why wouldn't you? Look at the history on this thing. You can go back. You can use the hard right edge. Now, if you don't know how to trade the hard right edge, if you've never heard that phrase before, let me show you one way that we can do this. So we set Thinkorswim. I'm going to use 2 minutes for my example. I want to give myself plenty of days to look at on the chart. So now I've got a 10-day, 2-minute chart. Come down to where the numbers are at on the bottom and left click. Drag that to the left. Stretch these candles out. Okay, that's a pretty good price action. That's a 1 full day from open to close. Okay, now instead of grabbing the numbers, I want to grab the slider down here. Left click on the slider, hold the button in again, pull it across. Now I've got 10 days to the right. This is the start, the first day of 10 days. All right, the market is opening in Globex time at 6 o'clock. We're ready to run, and I can now look at the hard right edge, which is the right side of my chart, and I can say I'm looking for a trade. Where's my trade? So I'm rolling the wheel on my mouse. I'm not clicking the wheel, I'm rolling it, and each candle presents itself as I roll. Well, there was our entry, by the way. We passed it up. So if I'm looking at this, we're in the overnight hours. I'm looking for a trade. I'm looking for a trade. We tagged the 75 right there. When we tagged it, my first indication would be, oh, hey, look, we're going bullish. Look at that great spike we just had right there. I need to wait for candle close to see if we're going to close above the 75. The candle closed below it. The next candle closed below it. I don't have a trade yet. If I wanted to go long, I don't have a trade. But what I do have is a rejection at the 75. I've got 2 candles showing me that rejection. But look at the sellers that are getting bid back up by the buyers here. Let's see that wick. So we came down to 72, and then buyers stepped in and brought us back up again. So this is showing some indication here. It's showing some strength. All right. Next candle, getting a bit whippy, right? So this is showing us that we don't have no bullish action here. We can't get that close above the 75. If you had taken this short from the rejection, your target would be 78.50. We're not getting there. Instead, all we did is we came right back down into this price structure where it's looking to find some support. Came back up and tested that 75 again. Now, that's an important distinction. Every time we test a level, it's like trying to bang our way through the door, right? Persistence beats resistance. If we look back here, price came down and knocked on the 75, got rejected, tried it again, got rejected. It didn't even get down to test it at this time. Took a big pullback and a running start and broke through it. Persistence beat resistance. But now we're underneath it, and we're doing the same thing again. Test, fail, test, and fail. Test it again, failed. But look at the rejections. These rejections, see 1, 2, 3, 4 candles here. That's 8 minutes, almost 10 minutes. This wasn't a strong rejection. This was a soft rejection. Price eased off away from the 75. Notice over here when price hit that 75, look at that big green candle there. The rejection was strong and hard. We call that a hard rejection. Right? We went from the 75 all the way up in the next candle to 78, almost 79, 79.5. So a strong rejection there. Look at these little candles. That was a soft rejection. That's letting you know, hey, this is probably going to come back up again, right? So we just keep scrolling. What do we get? We get another opportunity, and this one closed above the 75. At that point, we could go long here. This is how we can use the hard right edge. We could ask the question, if I go long here, would it work out in my favor? And where would I put my stop? At the very least, I would want my stop to be below this stuff, right? Because that's where price keeps coming back down and testing this range. I wouldn't want it to come down and kick me out of my trade, right? So I would want to be at least below all of that. So let's say I give it 15 points. That's the 75. So we can look at putting our stop somewhere around the 60. 15 points, that's $30 worth of risk. Would that trade work out in my favor? Well, why not, right? I'm bullish looking at this. Let's see what happens. So we're still struggling with that 75. There's our break up into the 80s. Oh, am I going to get, I did. I got stopped out right there. So, there you go. We would have got stopped out at the 60. So this trade went from being bullish to bearish. What happened? Was there a change in market sentiment? Was there news? Well, it was 3 o'clock in the morning. That's 4 o'clock market time because I live in Kansas. So what happened at 4 in the morning? Was there economic news that came out? Did something happen over in Europe? Right? What event caused this sudden change in market sentiment? And this is a sudden change, just like this was a sudden change. So that's one. Scroll. The bearish market continues. When we broke this 50, we would have been looking to go to the 25. We broke the 25 here soundly, right? It came down, it found support. The support couldn't hold, it broke through. Same here when it broke. Price tried to rise back above it a couple times, it couldn't do it. Failed, and where did we go? To the 25. So here, where are we headed? To the roundy. Now notice what happened. Price quit falling, consolidated, and built a base. Tested that 25, took a soft rejection, tested it again, and broke through it. Now it's riding on top of it. So we're no longer looking for the roundy. We're looking for the 50. This is called using the hard right edge. This is how you can use this to determine if your trade strategy is appropriate or not. So we're back down to where we started. We still haven't taken a loss yet if we was to have gotten in at the 25. We came really close to the 50. Now what is this pointing out to you? That perhaps running from exactly quarter to exactly quarter might not be a good idea. Maybe we want to front run that, since we see that sometimes this price gets really close and then starts to fade out. What would have been an indication that we should close the trade out here in the 40s and give up on the 50? Remember, we don't want to just bail out of a good trade unless we see something that indicates we should be bailing out of the trade. So this big candle here that failed to get us to the 50, that was a good heads up. And then we consolidated a bit, and we took another run, and look at the wicks up here. It again didn't make it to the 50. And we went from this trending price action to consolidation. We're getting a lot of warnings here that price is struggling in this range to get up to that 50. Just take profits and get out of the trade. Remember, from the 25, we seek the 50, unless we get a close below the 25, and then we seek the roundy. So again, another opportunity, but this time, no warning in the reversal. We went from trending up, got rejected at the same level we got rejected, and came back down and broke the 25 to the downside. It's a very whippy market that day. And there's our range-bound market. That's why I don't like to trade a range-bound market. I'd rather trade a trend. Now, the reason I'm taking this slow walk through the Nasdaq with you is so that you can understand and recognize these levels. Look at how often price goes from the 25 to the 50 or from the 50 to the 25. Recognize that it doesn't always get right to the 50 or the roundy or the quarter. Recognize that you're going to have to learn price patterns. There's no indicator on my chart. I don't need one. I don't need to see the stochastics or the RSI or the MACD. I need to see, did price connect with the half? Did it get rejected? How hard was that rejection? In the rejection off the 50, where did price stop falling? Was it at the earlier level of my resistance? Did that resistance become my support and hold price up? Or did it fail there? Where's my reversal? When could I anticipate my trade entry? How much of the trade should I take before I close the trade with profit? Now, we don't have to trade from 25 to 25. We could trade from 25 to 10. We could just take 10 points. That's $20 a trade. There's nothing wrong with that. But if you only take 10 points and you close the trade and price is here, you now need to wait until price makes contact with a half or a roundy before you get another opportunity to trade. If you're taking 10 points, you could increase your contract size. So instead of only taking one contract to 50, you could take two contracts to 10 or 15, right? We will get into strategies in the next video. But I really need you guys to see these levels, to understand that the entire Nasdaq strategy that we're going to be using is based on where did the candles come from and where are we going. I need you to see the big picture. Zooming in on the day and trading this doesn't do us a lot of good without the perspective, right? Now, if you're like me, you trade on something other than Thinkorswim, right? When it comes to trading the futures, Thinkorswim is too expensive for me in their contract requirements. So I don't trade on Thinkorswim, which means it becomes the perfect tool. I can look at Thinkorswim and I can trade on NinjaTrader or Tradeovate or whatever you're interested in trading in. Now, one thing that I like to do is I use the Flex Grid. This big space right here is where I will put my NinjaTrader dome. That's what this is called, the dome, the depth of market, or it's also called the active trader. So I'll give myself chart space and I will put my dome or my active trader for NinjaTrader right here. And I will be looking at the Nasdaq on Thinkorswim. And if I don't do that, then I bring up my 4-grid. That's not the 4-grid I want. I look at all 4 of the indexes. If I'm interested in trading the Nasdaq, I keep track of where we're at with those levels, but I also look at where the other 3 markets are at. These 4 markets move in sync more often than not, but most often one of them will lead the pack. It used to be exclusively the Nasdaq, but lately I have found days where the Russell is giving me the earliest warning or the heads up. Some days it's strongly in the Dow, and more often than not lately it's been the Dow that's been the leader. So when I'm looking at all 4 of these together, I start looking for these price shelves, these areas of near time support and resistance, and then I get my trade triggers. So how can I demonstrate this to you when the market is closed? Because this is the weekend. So we'll dial back to right here. And let me zoom in so that this is appropriate on both charts. So here's the big candle on the Dow. I'll just stop my mouse right there after I zoom in on these others. That looks about right. There's that big candle on the Russell. And there's that candle on the S&P. So when I put my mouse right there, you can see that all four of these markets had that big green candle at the same time. Now, what do you see when you look at all four of these with my mouse parked there? On the Nasdaq, it broke the half and got rejected. Okay, it faded back down. It also broke this near time overhead resistance that this price shelf had made. And when it faded down, it faded right to that level. So it found support from this price structure. So let's go over and look at the S&P. When it had that big green spike, what did it do? It broke the overhead resistance and it faded down to that same level, which now became support. What about the Russell? The Russell didn't break through. The Russell got rejected at that level and it faded down below it and then rallied up later on. Right? So the Russell isn't moving with conviction as these two are. So what about the Dow? It was already at that level when it popped. If you weren't watching it at the time, I can tell you now, the Dow led this pop. It was the one that popped and the other three followed. I know this because the Dow was the one that led the charge. It had already reached that level before it popped. It didn't have to make a climb to get to that level. It was already there. The Nasdaq needed to make a climb. The S&P needed to make a climb. The Russell needed to make a climb, but not the Dow. It led price action up into that point, and then it broke above it at that candle. Okay? You can get your heads up from this. More often than not, when the Russell is the one leading the way, I've been watching it lead us lower. What we would see is when I demonstrated to you that the Russell had failed to break out at that level. Let's find that level again right here. When it was rejected here, if the Russell was leading and it had began to fall and not find that support here, it would lead us lower, break this level while these would still be moving up. And this would be my early warning that, hey, don't trust the rally out because it's not being backed up by the smaller markets. I've seen it again and again and again, but what I'm looking for is Confluence. When we had the break in the Nasdaq and it found support and came back and broke through the 50 again, I would have been more confident in taking that trade to the upside because I had the rest of the market also moving in sync with me. Now, since the charts are all matching together, when I move my mouse on the Nasdaq, you see it on all the other markets. Look at how the other markets are reacting through this whole pattern when we broke the 50 here. They're all finding support at areas where there should be support. They're all breaking through their resistance levels where they should be breaking through the resistance levels. Not one of these is moving against the trend. So I have more confidence in staying in the trade and taking the long position. All right? So that's the Nasdaq. That's how I use the Nasdaq. That's how I look at the Nasdaq, and this is how I look at all four combined. You can use all of this and trade the ES instead of the Nasdaq. It doesn't matter which one you decide to pull the trigger on. What matters is that you are recognizing the Nasdaq hits these levels and becomes exhausted temporarily, pauses, reverses. Right? So when you apply that in a trending market, you can anticipate where price is going from where we came from. That's it. It is really that simple. It doesn't have to be complicated. It doesn't have to be complex. We don't need the Ouija board and the crystal ball. We got it all right here. So in the next video, we want to talk about contracts, various ways that we can look to trade the contracts to take risk out, to let runners run, and perhaps even the overnight trade that I was telling you about. These are not complex or difficult trade setups, and the main thing that I want to instill in you is that I'm giving you the bones of the strategy. I'm going to give it to you the way that I use it, but it is meant to be adapted to your trading style. That's the great thing about a strategy that is not overly complex. Each individual trades differently. And you'll be able to take what I show you and apply it to trading in a way that is comfortable to your risk and to your level of analysis of the markets. I do want to thank you very much for watching this video. And I look forward to seeing you at the next one, where we will discuss the trade strategies for the Nasdaq.